So, okay, you put money into the stock market. Maybe you pick some companies,
Right.
or maybe a fund made more sense for you.
Right, hoping it grows over time. That's the goal.
Exactly. And you always hear about the S&P 500, yeah. It's that big benchmark everyone seems to measure against.
It really is the main one, certainly in the U.S.
But what if, and this is kind of the surprising thing we're diving into, what if the biggest challenge isn't finding that amazing stock, but just matching that average, that S&P 500 return? What if that's incredibly hard?
It really goes against the grain, doesn't it? We all want to do better than average, pick the winners.
Okay.
But the data paints a very different picture about how tough it is just to keep pace.
And that's exactly what this deep dive is focused on. We've got a whole bunch of sources here, articles, research, all looking at this fundamental difficulty of beating benchmark indexes like the S&P 500. So our mission today is to unpack why. Why do the vast majority of investors, and yeah, that includes loads of professionals, fail to beat the market average consistently over the long run? We're going to use the insights and the numbers from these sources to get a handle on the forces at play.
And we'll also look at what the sources say about, potential strategies if you still want to shoot for those higher returns. But we need to be really clear about the hurdles involved. It's not easy.
Definitely not. And we're going to uncover some pretty eye-opening stuff, like there's some simple math that basically says most active investors have to underperform.
Right, the arithmetic of it.
Yeah, and the hidden costs that work against you, the weird way market returns are actually generated by just a few stocks, and even how our own brains, our psychology, can mess things up.
It's a fascinating mix of factors. Shall we dig in?
Let's do it.
Okay.
First up, the benchmark itself. What exactly is this S&P 500 we're always comparing ourselves to?
So think of the S&P 500 as like the main report card for the big end of the U.S. stock market. It's an index tracking 500 of the largest U.S. companies.
Okay.
And it's market cap weighted. That just means the bigger the company's total stock value, the more impact its price changes have on the index level. It gives you a broad picture of how these major U.S. corporations are doing collectively.
And historically, what kind of return are we talking about?
Over the very long term, including dividends, it's typically been somewhere in the, say, 7 to 10% average annual return range. Of course, it varies wildly year to year.
Got it. So beating the market average just means getting a return better than that index return for a given period. S&P does 10%, you get 15%, you won, you get 8%, you lost to the average.
Exactly that simple. And, while we focus a lot on the S&P 500, the sources are clear. This isn't just a U.S. thing.
Right. Other countries, other regions have indexes.
Totally. MSCI, ACWI for global stocks, the Nikkei in Japan, FTSE Global Euro Stocks 50 in Europe, The list goes on. And the difficulty of beating the local average, it's pretty much the same story, especially in big developed markets with lots of professional investors. The index is a really tough opponent.
Okay, formidable opponent established. So let's unpack the why. Why is it so consistently hard? Our sources point to 5 key reasons, kind of blending theory and just cold, hard data.
Right. The first big one the sources hit on is market efficiency, or the efficient market hypothesis.
Sounds academic, but what's the gist?
The basic idea is simple. You've got tons of smart people, institutions, algorithms, all watching the market all the time. So when new information comes out, earnings reports, economic news, whatever, it gets reflected in stock prices really, really quickly.
Almost instantly.
Pretty much. So if some news suggests a stock is suddenly worth more, the price jumps before you or I could likely react. It means finding genuinely undervalued stocks, those hidden bargains, is incredibly difficult on a consistent basis because the market is generally quite good at pricing things correctly based on known info.
Someone else probably saw it too.
Or a computer did. And William Sharpe, the Nobel laureate, he had this really elegant point called the arithmetic of active management. He said, look, before costs, if you average out all the active investors trying to beat the market, their combined return must equal the market return.
Because for every active winner beating the average, there has to be an active loser underperforming it by the same amount relative to the market return.
Exactly. Among the active players, it's a zero-sum game relative to the passive market return before you even factor in costs, which leads us straight into reason number 2.
Costs and fees.
The drag.
The big drag. This is Sharpe's killer second point. After you factor in costs, the average active investor must underperform the average passive investor. Active management costs money.
Well, you've got research teams, analyst salaries, fancy data feeds, lots of trading, which means commissions and bid-ask spreads, potentially higher taxes from frequent buying and selling. It all adds up.
Whereas passive index funds?
They just aim to track the index. Very little trading, minimal research needed, so their costs, the management fees are super low, often, below 0.1% per year. Compare that to active funds charging maybe 1%, 1.5%, 2%, or even more.
That difference sounds small, but it adds up, right?
Massively. The sources bring up that famous bet Warren Buffett made against hedge funds. Over 10 years, the S&P 500 index fund returned about 7.1% a year. The basket of hedge funds, they averaged only 2.2%.
Wow.
And a huge chunk of that difference was simply down to the high fees the hedge funds charged. Even with supposedly smart managers, they started way behind because of costs.
It's like starting a race 50 yards behind the starting line. That 1% or 2% difference compounded over 10, 20, 30 years.
Yeah.
It becomes enormous. One source called active management guaranteed to be lost on average because of this cost handicap.
It's a built-in disadvantage that passive investing mostly avoids. A guaranteed headwind.
Okay, so we've got efficiency making bargains rare, and costs acting as a penalty. Reason number 3 is maybe the most counterintuitive. Skewed performance distribution? What's that about?
This was really fascinating. Based on studies like Professor Bessenbinder's work, it turns out stock market returns are incredibly concentrated. Over the long haul, a very, very small number of stocks generate the vast majority of the market's total gains.
Wait, say that again, a small number?
Yeah, like one U.S. study found that historically only about 4% of all stocks accounted for basically all of the net wealth creation above what you could have gotten from safe treasury bills.
So what about the other 96% of stocks?
The majority of them, over the long term, actually underperformed even those super safe T-bills. Many lost value or just treaded water.
That's wild. So index funds win here because?
Because they own everything in the index. By definition, they hold those few superstar stocks, the ones that drive almost all the market's gains. They capture that skewed upside automatically.
Whereas an active manager, or you picking individual stocks?
You face the near impossible task of identifying that tiny fraction of future winners in advance. It's often described as looking for a needle in a haystack. You're far more likely to pick mostly from the 96% that, well, don't do much or even lose.
Like finding the next Amazon or Apple before anyone else.
Exactly. And we saw a recent example, didn't we? The Magnificent 7 tech stocks in 2023. They drove a huge portion of the S&P 500's return. Lots of active funds that were maybe trying to be diversified away from being too concentrated in those giants actually lagged the index because they didn't own enough of those specific massive winners.
Okay, so efficiency costs and this skewed return thing where only a few stocks really matter. Reason 4 brings it home with the actual results.
Right.
Most professionals lose too.
The data doesn't lie, huh?
It really doesn't. You look at reports like the SPVA scorecard from S&P or data from Morningstar, they track this stuff relentlessly, and the numbers are consistently, well, pretty brutal for active managers.
How brutal? Even in just a single year, you'll often find 60%, maybe 65% of U.S. large-cap active funds failing to beat the S&P 500.
So more lose than win, even short term.
Yep. And it gets much worse as you look longer term. Go out 5 years, and typically 80% to 90%, sometimes even 95% of active funds are lagging behind their benchmark index.
95% over 5 years.
It can get that high in some categories. Then look at 10 years. You're often down to maybe only 5% to 7% of active large cap funds managing to outperform.
So over a decade, well over 90% failed to beat the simple index average.
That's the common finding. And the sources point out that over 15 years, the majority of active funds underperformed in essentially all the main categories tracked. And finding managers who consistently beat the market year after year, extremely rare. One analysis over 20 years found something like only 1% of funds survived and consistently outperformed.
I saw a stat mentioned from the SPVA 2023 data, something like 98.64% of large-cap growth funds lag their index. I mean, that number just hammers it home.
It really does. Now, there might be slight variations, like the source mentioning value funds sometimes have a slightly better, though still poor, win rate, maybe 14–15%, beat the index. But the overall picture is undeniable. It leads to quotes like the one from Barry Ritholtz. Indexing gives you a better chance to be less stupid.
Yeah. If most people are underperforming, just hitting the average is a form of winning, relatively speaking.
In that context, absolutely. Which brings us nicely to the 5th reason, and this one hits close to home for all of us as individual investors. Investor psychology and behavioral traps.
Ah, how we get in our own way.
Totally. There are studies, like the Dalbar QAIB report, that consistently show the average investor in stock funds gets returns that are significantly worse than the returns of the very funds they own, and much, much worse than the market index.
How does that even happen? If you own the fund, don't you get the fund's return?
You'd think so, but Dalbar pins it on terrible timing. What happens is people tend to buy after the market has already gone up, buying high, and then panic and sell after the market has dropped, selling low.
Chasing performance and running from fear.
Exactly. The 2024 example in the source was stark. S&P 500 up over 25%, but the average stock fund investor only up about 10.5%. That massive gap is mostly due to bad timing decisions, being hesitant to invest, selling during downturns, and then missing the recovery rallies. Dalbar says this pattern of poor timing has caused investors to lag significantly pretty much every year since 2009.
So we let our emotions dictate our trades. Fear and greed.
Pretty much. All those behavioral biases kick in. Loss aversion, feeling losses much more painfully than gains, which makes us sell in panic. Overconfidence, thinking we know better than the market or can time it perfectly. And hurting, just following the crowd. Buying when everyone else is euphoric and selling when everyone else is terrified. These psychological traps consistently push investors into making poor decisions that damage their long-term returns.
Wow. Okay, so summing up the 5 reasons. Markets are pretty efficient, making bargains rare. Active investing has higher costs acting as a drag. Most market gains come from a tiny number of stocks that are hard to pick. The vast majority of professionals fail to beat the index anyway. And our own investor psychology often leads us to buy high and sell low. That's quite a mountain to climb if you want to outperform.
It really is. Those are the fundamental challenges laid out in the sources. They explain why beating the index is so tough over the long run.
All right, so the deck seems pretty stacked, but people are ambitious. The sources do talk about approaches for those who still want to aim higher than the index return. What do they cover?
They look at the main ways people invest and how they relate to this challenge. So first, there's individual stock investing, picking your own stocks.
The DIY approach. What's the potential upside they mention?
Huge potential upside, theoretically. If you do manage to pick one of those massive winners early on, think Amazon, Apple, maybe Tesla, and hold it, your returns could absolutely crush the index. Concentration in the right stock can lead to phenomenal wealth.
But the downsides.
All the things we just talked about.
Right.
It's incredibly hard to pick those winners consistently before they become winners. The risk is huge. Any single stock can tank or even go bankrupt. To manage that risk, you need diversification, but diversification dilutes the impact of any single big winner. And you're constantly fighting your own behavioral biases, the urge to sell too soon or buy too late.
So high risk, high potential reward, very difficult execution.
Extremely difficult. The sources stress needing deep analysis, patience, diversification within your stock picks, and serious emotional control. They generally suggest beginners should start with index funds as a base.
Makes sense. Okay, what about using active funds, paying a pro?
Right, hiring a fund manager who claims they can beat the index through skill.
But we just saw the data on that.
Exactly. The sources repeat, most active funds fail. Full stop. However, they acknowledge that truly legendary managers like Peter Lynch or Warren Buffett have existed. The problem is finding the next Buffett or Lynch before they prove themselves is incredibly hard.
Past performance isn't predictive, right?
Largely no. Good performance can be luck or a style that was in favor but falls out of favor, what they call mean reversion. So, picking a winning active fund is itself a major investment challenge. You'd need to really dig into their philosophy, track record consistency, and crucially, their fees, as we discussed.
Okay. Then there's the opposite approach.
Yeah.
Passive strategies, basically index funds.
This is the strategy of essentially joining the average instead of trying to beat it. You buy a low-cost index fund or ETF tracking something like the S&P 500, you get the market's return minus very minimal costs.
The main advantages being
simplicity, incredibly low cost, diversification is built in, and you get peace of mind knowing you're capturing the market's growth without needing to pick stocks or managers. John Bogle, Vanguard's founder, was the huge champion of this.
It's become super popular for a reason. Any downsides mentioned?
Well, you'll never beat the market, by definition.
Right.
And if the whole market goes nowhere for years, like Japan's Nikkei did for decades, or even the S&P 500 during certain periods, your index fund goes nowhere too. You're tied to the market's fate, good or bad.
Right. And the last category I mentioned is quantitative strategies, using computers and data.
Yeah, quant or algo trading, using complex math, data analysis, algorithms, sometimes AI, to find and exploit small, often short-lived patterns or inefficiencies in the market.
Like factor investing. Or high-frequency trading.
Exactly. Factor investing tilting towards things like value or momentum is one type. High-frequency trading is another, operating on tiny price differences at massive speed. The sources mentioned funds like Renaissance Technologies Medallion Fund as an example of, well, almost unbelievable historical success using quant methods, though it's famously closed to outside investors.
So potential for amazing returns if the models work.
Potential, yes. But the downsides are significant too. The competition is fierce. Any profitable strategy gets copied quickly, eroding the edge. Complex algorithms can also go wrong or interact badly, potentially making market swings worse. And for an individual, the technical barriers, the data access, the programming skills, it's generally out of reach, although some factor ETFs offer a simplified version.
Okay, so those are the broad approaches. Now, for someone listening who hears all this but still thinks, okay, I understand it's hard, but I want to try to increase my odds of beating the index, what specific actionable strategies or tips do the sources suggest considering?
They do lay out a few practical avenues, always with the caveat that nothing is guaranteed and risks are involved.
Understood. What's first?
1. Focus on long-term investment in quality companies, basically channeling your inner Buffett. Do deep homework to find really strong businesses you think can grow for decades, buy them, and then just hold on. Let compounding do its magic. Needs skill, needs patience, lots of patience.
Okay, what else?
2. Utilize factor investing. We touched on this. You can intentionally overweight your portfolio in factors like value, small cap momentum, quality characteristics historically linked to higher returns. You can do this via specialized factor ETFs or try building it yourself. But remember, factors are cyclical, they don't always work, and they add different kinds of risk.
Right. Number 3.
Diversify and rebalance strategically. Beyond just owning different things, regular rebalancing, say, once a year forces you to sell some of what's done well, sell high, and buy more of what's lagged, buy low, to get back to your target allocation. It's a disciplined way to potentially improve your risk-adjusted returns. Maybe not always higher raw returns, but smoother.
A disciplined approach. What's next?
4. Try to entrust to a good active manager. We know it's hard, but if you believe you can identify one of those rare managers with a truly consistent philosophy, a proven long-term process, and reasonable fees, then allocating some capital there is a theoretical path. The challenge is the if.
A big if.
Huge. 5. Use strategic hedging and leverage. These are more advanced tools like options or futures. Hedging aims to protect against losses. Leverage aims to magnify gains. Very risky, needs expert knowledge and precise timing. Get it wrong, and losses can be much bigger. Definitely not for everyone.
Yeah, sounds like pro territory.
Yeah.
Anything else?
Yes, and this one is crucial and often underrated. 6. Optimize cost and tax efficiency. Seriously, don't underestimate this. Minimize trading costs. Choose the absolute lowest fee funds for your core holdings. Hold investments long-term to defer capital gains taxes. Max out tax-advantaged accounts like NISAs, 401k, IRAs. Reducing these losing factors, costs and taxes, can easily add 1% or 2% to your net return each year compared to someone who ignores them. That's like finding free performance.
That's a really powerful point.
Yeah.
Control what you can control. Before chasing elusive extra returns, stop the bleeding from costs and taxes.
Absolutely. The sources stress that none of these guarantee you'll beat the index. They all involve effort and usually more risk. You have to understand them and see if they fit your situation.
Okay, so let's pull back again. We've gone through the why it's hard and the how some still try. What's the main takeaway message from these sources?
I think the core lesson is that beating the broad market average consistently over the long term is just statistically and structurally very, very difficult. Market efficiency, costs, the skewed nature of returns, professional track records, our own psychology, they all stack up against it.
So index investing isn't just the lazy option. It's presented as a really smart, rational base case.
Exactly. It's shown as a reliable, super low-cost way to capture the market's return. And since beating that return is so hard, achieving it efficiently is actually an optimal outcome for most people trying to build wealth over time. Consider it the solid starting point.
But if you do have that ambition, that drive for more,
Then yes, strategies exist. Picking great stocks long-term, using factors, maybe finding that rare star manager, using advanced techniques. But the sources frame these as requiring much more skill, time, effort, and definitely carrying higher risks. It's not portrayed as an easy win, more like an adventure, as one source put it, that needs serious preparation and realistic expectations about the odds.
and the sources also hinted at the market evolving, right? With passive investing getting huge AI, social media influencing things.
They do touch on that. The landscape is always changing, but the underlying reasons why beating the average outcome of all market participants is hard, the efficiency, the costs, the math, the psychology, those seem pretty fundamental and likely to persist.
Which leads us with that simple, maybe slightly unsatisfying truth from the sources. It is difficult to beat the index in the long term, but it is not impossible. But the crucial first step is understanding why it's so difficult.
Knowing the challenge is key, regardless of whether you decide to embrace the average or fight against the odds to try and beat it. It informs your choice of strategy.
Okay, well, that brings us toward the end of this deep dive. We've really unpacked why that market average, the S&P 500 or similar indexes, is such a powerful force and, frankly, a really tough benchmark to consistently get ahead of over the long haul. The data is pretty clear, and the reasons make a lot of sense when you lay them out.
Efficiency, costs, skew, professionals struggling, our own behavior. It's a compelling case.
It really is. And while wanting to do better is natural, I think acknowledging the sheer strength of just achieving the average is, well, vital for any investor. It helps set realistic expectations.
Grounded expectations are key.
Definitely. So as you're thinking about all this, here's a final thought to chew on, kind of pulling from those hints about the future in the sources. With so much money pouring into passive index funds worldwide, and with technology like AI constantly changing how information is processed and trades happen, how might the nature of that market average itself change? Could the ways to potentially beat the index shift? Could it become harder? Or maybe even easier in some niche ways? What does that evolving picture mean for your own investment journey?
It's a dynamic world out there. Definitely something to keep pondering as you manage your investments.
Indeed.
Yeah.
Well, thanks for joining us on this deep dive. We really hope breaking down this challenge of beating the market has given you some valuable perspective for your own financial thinking.